Except for materials used under the Creative Commons license, this presentation is copyrighted by the University of Idaho. You are free to use these materials for educational purposes as long as you cite the author, Luke Erickson, and the University of Idaho as the source. Now, Avoiding Predatory Mortgage Lending by Luke Erickson. The financial crisis, which began with the implosion of the subprime housing market in 2008, drew lots of attention to the unscrupulous activities of a wide variety of bad actors in the housing market. Lenders, brokers, appraisers, credit rating agencies, securitizing agencies, government policies, even borrowers themselves all had a hand in the housing market collapse. Some of these were merely actors in the subprime housing market, but some were full-fledged members of the predatory mortgage lending club. Subprime lending is creative lending, which uses tiered pricing to allow borrowers with poor credit, insufficient down payments, and the like to still qualify for a mortgage, albeit at a higher price. This is because fees are distributed unequally with tiered pricing. Essentially, subprime borrowers end up paying more than their share in fees, allowing prime loans to be sold at lower prices. Predatory mortgage lending is targeting unsuspecting and uninformed borrowers with these creative home loans with promises of low costs and omissions of expensive loan features. Predatory mortgage lending, as it is known today, has been around for less than 20 years. It flourished from about 2002 to 2007. While predatory mortgage lending has receded since 2007, it is still a problem. There are fewer subprime lenders now than there were 5 years ago, and the rules for making loans are more restrictive. Consequently, the threat of predatory mortgage lending is a far cry from what it once was, but borrower beware, because predatory mortgage lending is certainly not dead. It's down for the count, but it's scrappy and can still sock it to you if you aren't on your toes. How does predatory mortgage lending occur, and how can I avoid it? I thought you'd never ask. Predatory mortgage lending and subprime lending are not the same thing, and yet there is so much overlap that it can sometimes be difficult to tell the difference. To illustrate the difference, let's use an example we can wrap our minds around, or at least our taste buds. You could buy a tasty sugar-packed soda at the grocery store for maybe 50 cents. Only a block away, however, at a gas station or convenience store, that same soda will cost you around $1. Next, visit a carnival, a fair, or a theme park and see if you can find that same soda for anything less than $2. This is tiered pricing. Is it fair? Maybe not. Nevertheless, I've been guilty myself of buying a $2 soda on a hot summer's day knowing full well that I was being overcharged for it. The point is, the immediacy and convenience of having that soda now is sometimes worth the $2. Thus it is with subprime lending. Subprime loans are more expensive in terms of both interest rates and fees. And who would want a subprime loan anyway? Well, those who are stuck inside the carnival, figuratively speaking. It's for those who have poor credit or lack a sufficient down payment for a conventional loan. The immediacy and convenience of a more expensive subprime loan may be worth the expense to some borrowers. Where does predatory mortgage lending fit in this scenario? Well, imagine you had a friend who we'll call broker, and that your friend broker takes you to a carnival. You ride a roller coaster, which we'll call bad credit, and you ride all day until you're tired and thirsty and just want to go home and relax on the lazy chair with a cool 50-cent soda. But on your way out, a beefy security guard we'll call fine print informs you that you must purchase a huge balloon before you can leave. Okay, you say, playing along, how much? $100,000, he says. You laugh, but he doesn't. We'll call this a balloon payment. You realize that your supposed friend broker is long gone, and you back away thinking perhaps you'll find another way out. But in the meantime, you're still thirsty and you decide to give in and buy a $2 soda while you wait. But you notice that the price is adjusted up to $3. We'll call this an adjustable rate soda. You reluctantly pull out $3 and then learn that with the additional soda credit insurance fee and soda prepayment fee, the total is now $4. You wish you'd never come to this carnival, but you didn't really know what you were getting into when you entered. No one really told you. How's that for a taste of predatory mortgage lending? It can be boiled down to a few simple ingredients. That's high pressure, lack of borrower education, and is often laced with a bit of trust. Quote-unquote friends are often predatory lenders, steering borrowers toward products and situations they don't understand and really can't afford. Features of loans that are more likely to be used in predatory mortgage loans include adjustable rate mortgages, teaser rate mortgages, interest-only loans, balloon payments, credit insurance, high fees, finance fees, hidden charges, and prepayment penalties. Characteristics of borrowers who have a higher than average likelihood of falling victim to predatory mortgage lenders include those who are very old or very young, those who are minorities, have low income, have high debt loads, have bad credit, lack general financial literacy skills, and succumb easily to peer pressures and instant gratification. Instead of trying to memorize all potentially harmful loan features and trying to change who you are, I simply suggest that you follow the cardinal rule when purchasing any financial product. Shop and compare 3 options before choosing one. Once you've selected 3 lenders, have a financial counselor or home loan advocate help you compare their features and fees. Return and have them look over your loan documents with you when it comes time to sign on the dotted line. This is good advice for anyone regardless of credit score, educational level, or financial resources. A final word of caution, government regulation is attempting to crack down on unscrupulous lending. Many of those involved in the quick bucks of predatory mortgage lending now have slithered onto other schemes and scams, including but not limited to loan modification and foreclosure rescue scams. They hope to make even more money off of you by helping you get out of the home they got you into in the first place. Again, seek help from a qualified financial counselor if you find that you're losing your home to foreclosure. We'd like to hear what you think about this presentation. You can do that by clicking on the SurveyMonkey link that is accompanying this presentation. Additionally, I am the author of this presentation, Luke Erickson. I am available and free to come teach this presentation or another topic of your choice to an audience of your choice, and I do that for free as a service through University of Idaho Extension. Of course, if you are outside of a 90-mile radius from Rexburg, Idaho, where my office is located, you'll need to pay for associated travel costs in order for me to come to your audience. As a reminder, this presentation material can be used for educational purposes as long as you cite me, Luke Erickson, the author, and the University of Idaho as the source. Also, there are photos used under the Creative Commons license, which the individual photographers and artists behind those photos can be found in the PowerPoint presentation, which is linked to this presentation. Now, the University of Idaho Extension System does not sell, promote, or endorse any financial product or institution. Our programs are strictly educational. Seek professional advice from your accountant or financial advisor for specific product information. The University of Idaho provides equal opportunity in education and employment on the basis of race, color, national origin, religion, sex, sexual orientation, age, disability, or status as a disabled veteran or Vietnam-era veteran, as required by state and federal laws.